Hey there, mortgage mavens. Today, we're diving into the wonderful world of home loans here in Bend, Oregon. So buckle up, because we are about to explore the top 10 frequently asked questions on the epic clash between the conventional conforming home loan and their feisty counterpart, the jumbo home loan. It's a battle of titans, and I'll be your host, guiding you along the way through the twists and turns of conventional versus jumbo. So, question number one, what's the deal with conventional conforming home loans? The trusty conventional conforming home loan. Most of the world uses the conventional conforming home loan. If you are a vanilla borrower that lives in a box, W-2 salary hourly, you're probably going to be in the conventional conforming box. And here in Oregon, that loan limit, not purchase price, that loan limit, $726,200 as of 2023. Now, the challenging part, Bend, Oregon, where we live, you're kind of dancing the line. The average median home price is somewhere in the high 800s. You put 20% down on a home and you're kind of dancing that line a little bit. So it's good to know the difference between a conventional and a jumbo and when and what scenarios you might choose one or the other, especially if you're kind of right on that limit. So question number two, what's the hype with jumbo home loans? So jumbo loans are the flamboyant cousins of conventional loans. They're like the rebels who dare to venture beyond the standard limit. So if your dream home comes with a pretty hefty price tag and it hops over that conventional conforming limit, you're now in jumbo territory. So question one, what is a conventional conforming loan? Question two, what is a jumbo loan? The baseline answer is anything above 726.2 is a jumbo, anything below is conventional. Question number three, credit scores, the battleground of eligibility. For conventional loans, a decent credit score can get you a ticket into the party towards homeownership. Typically a 620 or more will get you in the game for a conventional conforming loan. Jumbo loans, however, they demand more. They will typically raise an eyebrow. If you do not have a stellar credit score, you'll get hounded by an interest rate if you have anything less than stellar credit. I've seen jumbo loans go as low as 680 for a mid score, but typically they like to see a 740 or higher on those. And it's just, there's more risk involved, so they want to make sure the borrower has a better borrower profile. So in the jumbo territory, you're gonna need to aim for the high 600s, and if you've got stellar credit, then certainly that's a great eligibility tool to think about. Question number four, as Jerry McGuire would say, show me the money. So typically with jumbo loans, there are reserve requirements, whereas conventional conforming loans, there are not. So with conventional loans, you might be able to get away with having a smaller piggy bank. But when it comes to jumbo loans, they're going to want to see you flex your muscle. They want to see some asset. They want to see some credibility behind you. So they're going to require you to have a reserve requirement. So a standard reserve requirement in jumbo loans is they're going to want to see 3 to 6 months of that subject mortgage payment in a liquid asset form. If you have any additional real estate, they also would like to see 3 to 6 months of each rental property that you have as well. And every investor is a little different, but generally speaking, a reserve requirement of 6 months of the subject mortgage payment after your closing costs or your down payment is a good rule of thumb. Question number five, self-employed borrowers and their challenges. The self-employed adventurers. Many people, myself included, are self-employed, and that presents a lot of challenges to jumbo borrowers. So while conventional conforming loans have pretty good guidelines for self-employed borrowers, it's a little bit of a trickier maze with a self-employed borrower who's looking for a jumbo loan. You can expect extra documentation. We're going to want to see the last few years of your tax returns, a year-to-date profit and loss statement. Depending on the investor, they're going to want to see a balance sheet. You can typically get away with some, the ability to use cash from your business bank accounts, but a lot of investors have restrictions there. And then if we do allow that, they're going to want to look at your last 2 years tax returns, provide an expense analysis, and do what is called a cash flow analysis to determine that you're not using all of your assets in your self-employed checking account to buy a home. So then you can no longer actually function your business. So that's a big one as well. So jumbo loans typically require 2 years of self-employed tax returns And what we will do is we will average out the 2 years. So if you had a good year and last year was mediocre or not quite as good, then we're going to average that out. The one thing to think about with jumbo investors is if you have a down year, but last year was a really good year, we're actually going to look at it as declining income, and we're going to use the worst of the two. So in the better situation, we're going to average it out. In the worst situation, we're going to take the worst if your worst tax return is the most recent year. Just riveting information, I know. Okay, question number 6, down payment, a battle of wits. When it comes to down payments, conventional conforming loans, you can get away with as little as 3%. You can put 3% down and achieve a home loan of $726,200. 3% down. Jumbo loans, not so much. A few years back, you could get away with a jumbo loan with as little as 5% down. In 2023, economic conditions, there might be one investor out there, but man, the interest rate's going to be high. Typically, in today's environment, jumbo investors, jumbo banks, myself included, we like to see a down payment of 20%. There are some 10% that exist. There was a 5% exist for a minute. 20% is the baseline entry point to get you a great interest rate coupled with a good credit score. So if you have a good credit score and you're putting 20% down on a jumbo loan, that's going to be where you're going to get the best of both worlds. In the jumbo environment, the more you put down, the greater the interest rate offering is going to be because it's perceived less risk by the investor. Question number 7, debt to income ratios. This one gets people all the time, especially in today's high rate environment. Affordability is a big factor. So we have this debt to income ratio duel that exists between conventional conforming and jumbo loans. Conventional conforming loans, you can get away with 49.99% of your gross income, your before tax income on all debts. So if you make $10,000, just assume you can use $5,000 on debts. You have $2,000 a month in liability, student loans, car payment, whatever. That leaves you with $3,000 a month in your mortgage. The jumbo loan territory, however, only allows about 42%. And so just think of it that way. If you've got $10,000 a month in gross income, you can use $4,200 on all debts. So conventional conforming will allow you to go higher. Again, jumbo loan, perceived riskier investment for banks and investors. So they like to see a lower debt to income threshold. All right, question number 8, appraisals. So conventional conforming loans typically have smoother appraisal processes. Jumbo home loan appraisals actually have a little bit more to them. They're typically a higher priced home. Maybe there's some more complexity to the property itself, and just maybe some things that are outside the box. So one, jumbo appraisals typically cost a little bit more than a conventional conforming loan appraisal, and there's sometimes a little bit more complexity. With jumbo loans that are typically $1 million or more, you're going to need to do what is called a CDA, which is a certified desktop appraisal. So the appraiser is going to go out, and they're going to provide the appraisal, and then we're going to submit that appraisal to the underwriter, and they're going to do what is called a CDA. And what they're looking for is any kind of information that could deem it a declining market, or they're just going to scrutinize it a little more. Again, it's a riskier investment for them, so they have more requirements. So in a conventional conforming loan, you're not going to have that. But in a jumbo loan, depending on the investor we choose for you, there might be what is called that CDA. And in some cases, north of $1.5 million on a loan amount, you may require 2 full appraisals, 2 different appraisers to come to the same conclusion. Not uncommon, not usually a problem, but not uncommon. Question number 9, interest rates. What's the difference between a conventional conforming loan and a jumbo loan? In times past, conventional conforming loans actually came with lower interest rates. However, the last 6 or 8 years, jumbo home loans have actually had slightly better interest rates. There was a pretty big gap here about 4 years ago, but that gap's definitely closing. So now you're kind of right there either way. When it comes to interest rates in conventional conforming loans versus jumbo loans, so conventional conforming loans actually, there is a lot more of a complex grid that exists between having a higher and a lower interest rate, a higher and a lower credit score, and down payment. So there's a little bit of a grid that exists that will indicate one way or another where your interest rate falls, whereas jumbo loans it's kind of tiered, 20-point increments, and also down payment plays a role. So what I mean by that is in a jumbo loan, if you were to put 40% down, it doesn't, your credit can be weaker than better. So in the bank's mind, having a higher credit score and lower down payment actually is less appreciated over a lower credit score and a higher down payment. So just again, it all comes down to perceived risk by the investors. All right, question number 10. We are here. We made it to the end. And here's my call to action to you. YouTube people of the community, if you are still unsure whether a conventional conforming loan or a jumbo home loan is right for you, you know where to find me. You clicked on this, make sure you click like, subscribe, and comment below on any questions you might have for me. Certainly you can call me, text me, email me, walk in, apply on LinkedIn, Twitter. I don't care how you get a hold of me, just connect with me. Happy to answer any of your questions. And finally, as I always say, if you can pay cash, pay cash. But if you need a home loan in Central Oregon, I'm Derek Meyer. Don't hesitate to reach out. Have a great day.